Hi, good evening. Am I audible and is my screen visible? Good evening, Imtiaz. So, Anil and Imtiaz, just two of you today attending the session. Was there any miscommunication? Because I said yesterday that we'll be meeting the same time, that is 7. We'll be having the webinar at the same time. But still, I don't see anyone joining today till now. What should we do? We can wait for others till 7:30. You want me to wait for others till 7:30 and then you want me to start the webinar, but that's not done, Imtiaz. We can wait for some time, 5 or 10 minutes, but if still others are not joining, then we'll have to reschedule the webinar for tomorrow because the others will either miss the topic, or what we can do is, if you want, we can continue with the topic and they can see the recording. Whichever way you said, you guys say, I'm fine, I'm okay with that. If you want me to continue, I'll continue with the topic. They can view the recording, or if you want, we can again put a message on the Telegram channel that the webinar timings are from 7 onwards and take the session tomorrow. Yeah, let's wait for a few minutes. In the meantime, let's look at some of the stocks that we analyzed yesterday while doing the stock filtration. See, one was TCS. See the movement the stock has given. I told you to buy above this candle when the high of this candle is broken, and from 990 the stock has made a high of 2045. And see, this was standing on a good support. Even the 50 moving average was taking a support on 200 moving average, and the stock has given a good rally. And see the volumes as well, the volumes are good. And another stock that we discussed yesterday was Tata Motors, which formed a doji on a support. See the movement in Tata Motors on breakout of doji. I posted these two stocks on your Telegram channel as well. See the volumes and see RSI crossing 60, and on breakout of doji my buy was about 178. My first target was 185 to 90 levels, and it has made a high of 183 to 183.45. Fine, so now we have three people: Anil, Chetan and Imtiaz. Okay, you wanted to trade a Tata Motors in options. That means you already have knowledge about options, Anil. Great. See, intraday trading, Imtiaz, you are new to stock market or you are trading from some time in the market? If you are entirely new in the stock market, avoid doing intraday trading, because in intraday trading you need to be very proactive. You need to take decisions very fast. If you are new to stock market, I said yesterday that those who are new to stock market first start with trading in the cash market at least for few months, say 5 or 6 months, and then you move on to intraday. And futures and options should be your last thing that you need to do. See, Anil, I don't trade into commodities, so I won't be able to help you out in that matter because I trade only in stocks. So Imtiaz is saying I'm new. I used to take some calls from others and lost money. See, that is the thing. I mean, that is the reason why you guys are learning technical analysis, so that there is now no need for you to take calls from others, and now you can take your own decisions. Even if you get if someone tells you to buy a particular stock, then you can check it on your trading platform, on your charting platform, and then you can decide whether it is tradable or not. See, that's how people generally begin in stock market. Until everyone, they start by taking calls from others or from brokers, and then when they end up losing money, then that's when they want to learn that when other peoples are making money, then why we are the ones who are losing money. That's when they think about learning technical analysis and fundamental analysis and all these things. So now we have 5 people joined in, so I think we should begin with today's session. But today market recovered well from the lower levels. TCS, Tata Motors, most of the stocks gave good movement. So we'll be covering futures and options briefly. Now, when we talk about the stock market, we have two segments in the stock market. One is the cash segment, another is the derivative segment. Now, what basically is derivative? Derivative means which is derived from something else, the source of which is something else. That is derivative. Now, the difference between cash market and the derivative market is that when we trade in cash market, we all know that we can buy any quantity of shares as much as we want. We can even buy one share of any stock, and we can hold it for as long as we want. And we need to pay the full amount when we are doing buying shares in the cash market. Even if we are buying 1,000 shares, then whatever is the amount, we need to pay the full amount. But when it comes to the derivative market, now the derivative market, we can classify it further into futures and options. So when we are trading in derivative market, we are not required to pay the entire amount. Only the margin that is fixed by the exchanges, we need to pay that. And most importantly, we cannot buy any odd number of shares. There are some around 250 companies that are listed in the FNO segment, and the lot sizes are also fixed by the exchange, and we need to buy only in that lot size. We cannot buy, say, one share if you in FNO segment of any company. We need to trade according to the lot size. Now, if I take you to see the closing price today of, let's take example of TCS only. Now the closing price of TCS is around 2038.70. Now if we look at the lot size of TCS, then the lot size of TCS is at 250. 250 shares we need to buy. Now if you want to buy 250 shares of TCS in cash market, then if the amount that you need to pay is, say, 250 into 2038.70, that is the amount that you will have to pay, which is around 5 lakh and 9,000, something about that. But if we take the position in the futures lot, just a second. Now if we take a position in the futures lot, then how much are we required to pay for TCS? Now if you see This is TCS 20th Feb. This is TCS 25th April and March. So at any given point of time when we are doing trade, we are trading into futures and options. There are always three contracts that are open. One is your current month contract. Then the second is your near month contract, and the third is your far month contract. So if we look at 28th Feb expiry, and if you want to buy TCS, then we only need to pay 90,000 as a margin amount, and we'll get 250 quantity in the futures lot. So this is the difference between the futures and the cash segment. That in cash segment, whenever you buy a stock, you need to pay the full amount. But if you are buying a stock in a futures segment, then you only need to pay the margin amount that is fixed by the exchange. Right. And so what basically are futures? Now, a future contract is an agreement between a buyer and a seller of the contract that some asset, now that asset can be a commodity, that can be a currency or an index, will be bought or sold for a specific price on a specific date in future. Now, every future contract has an expiry date. Like this month, we have an expiry on 20th Feb. That is the last Thursday of the month. In future contracts, the expiry is always on the last Thursday of the month. And as far as options are concerned, previously in Nifty, for options, the expiry was also on the last Thursday of the month, but now we have started with the weekly expiry as well from this 11th Feb onwards. So when we talk about uh, options expiry in Nifty or Bank Nifty, we have weekly expiry, which is every Thursday of the week. And as far as the future contracts are concerned, the expiry is always on the last Thursday of the month, be it Nifty or Bank Nifty. Now, expiry is important from the point of view of options because, see, as far as your futures are concerned, you can always roll over your position to the next contract, to the next month's contract. But when we are talking about options, the value of your options become almost zero at the time of expiry. You cannot roll over your positions in options. So expiry is important from the point of view of options. If you're holding any option position into options, you need to square off your positions before the expiry. And we will talk about actually I'm on but missed it. Okay, fine. So there is not much of a difference if we talk about the cash segment or the future segment. The only difference is that in futures, when we buy a future lot, firstly, we don't need to pay the full amount, and we can trade only in lots. We cannot buy any odd number of shares, and we can hold the contract till the expiry date. And on the date of expiry, either we need to square off our position in this current month contract, and we can roll over our position to the next month contract by buying the future contract in the next month. Now, options are instruments that belong to the derivative family, which means its price is derived from something else. Now, both futures and options, if we say they belong to the derivative segment only. But as far as options are concerned, in options, the premium it is the premium that is traded, and there is no such thing as a delivery, and everything is done in cash. The settlement, whether be it futures or options, the settlement is in cash only. Whereas when we talk about cash segment, when we purchase a stock, we need to take a delivery of the stock. But there is no such scenario in futures and options. The price of an option is intrinsically linked to the price of underlying stock. A stock option is a contract between two parties in which the stock option buyer, that is the purchaser, has the right but not the obligation to buy or sell shares of an underlying stock at a predetermined price from the option seller within a fixed period of time. Now, in option selling, there are two type of options, which one is the call option and the other one is the put option. Now, in options buying, the buyer has the right but not an obligation. That means he will exercise the right only if he is in profit, or he will not exercise his right. Now, options are trading instrument for people who don't like to invest heavily in stock. It is basically an agreement between two parties to sell or purchase the right to an underlying stock. Now, for example, the buyer of an option pays a premium to the seller with the hope or speculation that the stock price may move up before the date of expiry. Now, in case if the price of the stock goes against the favor of the buyer, then he will not exercise his right to buy that stock from the option seller on the specified price that they have decided. Now, if we combine our technical analysis with the options, like yesterday we filtered out TCS. Now, if we see what was the option, what was the now when we talk about call option and put option, now the call option we will buy only when we are bullish on any stock. If we think that any stock will move up, that is the time we will buy a call option. And when we are bearish on any stock, that is the time we will buy a put option. Like yesterday when we filtered out TCS, we were bullish on TCS that the stock will move up. So if that time, if we had purchased the call option of the stock, we could have made good money. Like, let's see what was the, we will go to NSE side, we will go to equity derivatives. Let's check the historical data. Search. Select instrument type, it's stock options. Select symbol TCS. Select year, we'll select the current year, that is 2019. Select expiry, that is 20th Feb. Option type is call, and I'll take strike price as 2000, and I want a data of last 7 days. Now this is the data of TCS 2000 strike price. Now if you see yesterday, the price of 2000 call was around 15 rupees, and today the price has become 30. That is your investment almost double. And what was the margin that was required? The premium amount into the lot size, that is 15 into 250. That was the amount, that was your investment, and your amount got doubled within a day. If we have bought the call of 2000 strike price in the morning, because see, in morning when the market was down because of the surgical strike, it made a low of I think somewhere around, see, the low today was 3.75. No, the low was 9.40. So yesterday's closing price was 15 of 2000 call option, and today it made a low of 9.40. So had we bought the call option anywhere between 9.40 to 15, and the closing price, the last trading price was 30, so your amount could have doubled, or you could have more than doubled your amount if you had traded in the call option of the TCS. So you can combine your technical analysis, and based on your technical analysis, if you are bullish on any stock, then you can buy the call option of that stock, and if you are bearish on any stock, that time you can buy the put option of that stock. Now, open interest is one important data point that is associated with your futures and options. Now, when we filter out stocks in cash market, volume is one criteria that we use for filtering out stock. The volume of in the stock should be good in which we are deciding to trade. But when we talk about futures and options, so along with volume, we also check the open interest. Now there is a difference between open interest and volume. Volume is the total contracts that are traded in the market, but open interest means the total number of open contracts in the market. So yesterday when we saw the money control list increase in open interest along with increase in price and volume, that is what we saw yesterday. So open interest is different from your volume. So let us understand the open interest is what open interest is. Open interest indicates the number of options or future contracts that are held by a trader and investor in the active positions. These positions have not been closed or expired or exercised. Now, to understand the open interest better with an example, now see, open interest tells you how many future contracts are currently outstanding in the market. Now, how open interest is different from volume? Let's take this example. Now, see, Arjun buys 6 future contracts and Varun buys 4 future contracts, while Neha sells all of those 10 contracts. Now, Arjun and Varun both are buying from Neha. So, Neha is selling 10 contracts, Arjun is buying 6, and Varun is buying 4. So, the total open interest, the total number of contracts that are open in the market are 10. So, this is your open interest. Now, on the very next day, Neha wants to get rid of 8 contracts out of 10 contracts she holds, which she does. John comes into the market and takes on 8 short contracts from her. Now, Neha sold 10 contracts, so she was short on 10 contracts, out of which she decided to square off 8 of her contracts. So, she bought 8 contracts back from John. John sold 8 contracts and Neha bought 8 contracts. So, now Neha is short on 2 contracts. So here the open interest will remain the same. The open interest will be 10 only because no new contracts are open in the market. In fact, Neha is squaring off a position, but your volume will be 8. The number of contracts that are traded in the market are 8. So volume is 8, but the open interest will remain the same as there is no addition in the contracts. No new contracts are added in the market. Just a second. Now similarly moving forward, now to the existing 8 contracts, John wants to add 7 more positions while at the same time both Arjun and Varun decide to increase their long positions. Hence John sold 3 contracts to Arjun and 2 contracts to Varun. So now what John is doing, John is selling 3 more contracts, 7 more contracts. He's selling 3 contracts to Arjun and 2 contracts to Varun. Now John was short on 8 contracts, so 8 and 7, 15 contracts, and Arjun and Varun were short. They were holding 6 contracts and 4 contracts. So now Arjun is holding 9 contracts and Varun is holding 6 contracts. So here your total open interest is now 15 because 15 contracts are traded. So that's how we see the open that were traded. So the volume was 7, but your open interest was 15. So whenever we are filtering out stocks for futures and options, the criteria that we'll see is increase in open interest with increase in price and volume. FA segment, increase in open interest and increase in price and increase in. See, open interest, Anil, means you're all a part of that. Lost money. Open interest means total number of open contracts in the market, and volume means total number of traded contracts in the market. You want me to explain it with an example that we just saw? Fine. So see, on this day, on Monday, Arjun bought 6 contracts and Varun bought 6 contracts. And Neha was the seller. Neha sold 10 contracts, 6 to Arjun and 4 to Varun. So the total number of contracts that were open in the market were 10. So your open interest is 10. And volume is also 10 on this day because 10 contracts were traded in the market. Now if we move on to the next day, so now what is happening on this day, that Neha was short on 10 contracts. So she decided to square off position in 8 contracts. So she bought back 8 contracts from John. So now John is short on 8 contracts and Neha is, she's squaring off her position in 8 contracts. So now Neha is short only on 2 contracts. So she is just squaring off her position. She is transferring her position to John. So no new contracts are added in the market. So on this day, your open interest is 10 only, but your volume will be 8 because 8 contracts are traded in the market. See, if I show you this table over here. See, on Tuesday, Neha bought 8 contracts from John. John was the seller. So the volume is 8 because 8 contracts were traded in the market that day. But open interest remains the same because no new position is added in the market. Neha only squared off a position, but there was a trade in the market. So that is counted as a volume but not as an open interest. Similarly, if we look now on Wednesday, uh, John wants to add 7 more short positions. Now John was short on 8 contracts. Now he wants to add 7 more. So 8 and 7 is 15. And he sold 3 to Arjun and 2 to Varun. So Varun was holding 6 contracts. So now Varun has got 9 open contracts and Arjun has got 9 open contracts and Varun has got 6 open contracts, whereas John is now short on 15 contracts. And if we see what was the open interest and the volume on that day, now how many contracts did John sell? He sold 7 contracts. So the volume is 7 because 7 contracts were traded in the market. And Neha bought 2, Arjun bought 3, and Varun bought 2, but the open interest is 15. Why 15? Because John is now short on 7 contracts, so he is adding new positions in the market. New positions are getting created in the market. See, this open interest and these options are a bit complicated. That is why it is said that it is not easy to understand options, and options should be the last thing that you need to do in the market. And that's what I said, that people generally, they want to make money fast, so they start with option trading only, option futures and options. They don't do they don't go step by step in the market. Now, what we saw yesterday in this list, increase in open interest and increase in price. Say if the price of any stock is increasing and the open interest is also increasing, that means new contracts are getting add up in the market. And also if the volume of the stock is increasing, that is a bullish sign for the stock. That means long positions are getting built up in the market. People are bullish on that stock. Similarly, an increase in open interest and a decrease in price. That means your price is decreasing, but your open interest is increasing and your volume is increasing. This indicates that people are short in the market. They are shorting the positions in the market. More short are created in the market. So these are the two important things that we see if you want to filter out stocks for FNO trading. If the price is increasing along with open interest and along with volume, which that means that the people are bullish, more long positions are getting added up in the market. And when the price is decreasing but open interest is increasing and volume is increasing, that means the view of the most of the people on the particular stock is bearish, and they are creating short positions in the market. Now the third scenario is that your price is also decreasing and your open interest is also decreasing. Now if your price is decreasing, your open interest is also decreasing, that means the people, those who created long positions in the market, they are now squaring off the position. This is known as long unwinding. See, it is mentioned over here, decrease in open interest along with decrease in price mostly indicates long unwinding. The people, those who are long in any particular position, in any particular stock, or at any particular strike price, they are now squaring off their positions. And the fourth condition is when your open interest is decreasing, an increase in price mostly indicates a short covering. That means the prices are increasing but your open interest is decreasing. Means that those who were short in the market, they are now covering their shorts, because now they think that the stock price will not go down further. So whatever short they've created in the market, they are squaring off their position, they are booking the profit. Do you get it, guys, or anything that you want me to repeat? Nobody wants me to repeat anything? Anil is getting it. What about others? Getting it. See, what I tell you is that You go to this Zero the Varsity, they have this chapter on futures trading. There are how many modules in this? Around 12 modules are there. Even open interest is also covered in this. So you can go through these topics in Zero the Varsity. This will give you more idea about the future trading, about the margins, and also the hedging. Because see, these derivatives are hedging tools. Most of the big institutions, they use it for hedging purpose. But it is only us retailers that they use these futures and options for our trading purpose, and we end up losing money. So this is one mistake that we do being a retailer. So you can read about futures from Zero Diversity. Even as far as the options are concerned, you can read about options also on Zero Diversity. The call option, there are only two kinds of options which I told you about. One is the call option and the other one is the put option. Now when we buy call only when we are bullish on any stock, and we sell and we buy put when we are bearish on any stock. Options theory for professional trading. They have explained it beautifully along with examples. Call option basic, buying a call option, what is option, what is writing. Now writing, when we refer to a term writing in options, writing generally means selling. Whenever we say that a put writing is happening or when a call writing is happening, writing means that people are creating short positions, people are selling call or put. Now that we'll understand when we'll see the option chain tomorrow, how to analyze an option chain. Now option chain, you can also determine what is the support and the resistance for a particular stock, or if you're looking at an option chain of Nifty, then from that option chain you can make out what is the support for or resistance for the Nifty, and how you can find out whether the long positions are getting created, or long unwinding is happening, or short covering is happening, or short positions are getting created in the market by looking at the option chain. Now there are various strategies that are also associated with options, some advanced strategies which people generally use to hedge their positions. See, it's an interesting topic, Anil, but it's a very complicated topic, especially the options part. Because in options, you have different strike prices. You already know what options all about. When it comes to future trading, is there is not much of a difference between trading in cash market and future. The only difference is that in cash market you need to pay the full amount and take delivery of the stock, but when we are trading in futures, you need to buy in lot and only need to pay the premium, the amount that is fixed by the exchange. But when it comes to options, there are different strike prices, there are different premium for each strike price. Then where the open interest is getting built up, where the short positions are being created, where the long positions are being created. Yes, selecting a strike price is very important. Like we just saw an example of TCS. Now this is just one example. Now if you want, we can check for Tata Motors as well. What happened in Tata Motors 180 call? What was the price of 180 call yesterday, and how it what was the price today in Tata Motors? So if you combine it with what happened, T A T A T A. Let me scroll it down. Options is one topic that you need to go over and over. You need to read it. You need to go through the topic over and over again to understand it better. Now let's look at the strike price, say 180. Get data. Tata Motors. Why only? I'm asking for past 7 days. Okay. So yesterday the last trading price was 1.20 and today it made a low of 0.60. So had we bought it anywhere between 0.60 to 1.20 and today it made a high of 3.85. Now how much percent return is that? And what is the lot size of Tata Motors? 2000 is the lot size of Tata Motors. Yeah, it did made high of 4.65. I'm looking at the last traded price, that is 3.90. So how much percent return is that in just one single day? Now what we did was we simply analyzed the stock on a charting platform. We were bullish on the stock if it breaks the high of the doji, which it did beautifully, and see the run up that stock has given. So if we once we see it on our technical chart, and if we are bullish on something, 6,000 or 6,400, that you're talking about profit, Anil? 6,400 profit. And how much was the investment? 2,000 is the lot size. And even if you buy at 1 rupee, then it comes to around 2,000. So that means you are investing 2,000 rupees and you are getting profit of 6,400. That is more than what, 200%? 2,200 is the investment and 6,400 is the profit that you are getting. So that is what attracts people towards, option trading. But option trading, mind you, is very risky. Until and unless you have a good knowledge about the market, don't do option trading. Yes, Anil, that's what I'm telling. Option trading is very risky. It can wipe out your entire capital in just few seconds. That is why, there are various strategies that are used to hedge the positions. In that, these strategies are used to so that your loss is not there, that you're not losing your capital. Though the profit may be limited, but at least your capital is safe. That's why various strategies are used by people. Even those who are trading in futures, they, if someone is, long in any futures. Now let's take an example of today only. Now suppose yesterday if someone bought a future of, some stock, and today morning when he gets up and he sees that the Indian Air Force has created a surgical strike in Pakistan, and when the market opens, the market was down, and his future lot is also down. What will be the condition of that person? Because there was a big fall in the market in the morning, though the market recovered later. But if any such situation is there, or you can take an example of Brexit, when the Brexit took place, or when the on the day of budget, when the budget was out, when we saw that there was, The market was going down and down, and then there was a bounce back from the lower levels. Now, if someone is holding any naked future position, then what will be the condition of that person the next day when he gets up and he sees that the market is falling? So futures are very risky. These are basically futures and options. Chetan lost 30k. 30k, that's too much of amount. That's why it is always advisable, to use the strategies to, hedge your positions. Never trade into naked calls or options. So that's very risky. I just lost 12k in MNMPE, Anil, just 2 days back. Okay, but 12k is also not a small amount, Anil. If we look at from, you know, yeah, you had a chance to recover, but M&M didn't perform today also that much. Today 2.5 to 4.5. Mahindra and Mahindra. No, this is not the one. M&M. So it is almost at the same level, not making much of a movement. But now this range is getting built up. Now when it breaks this range, that is the time that we can see a good movement. It is about 10 moving average, that's okay, but now your RSI is almost flat. So when it breaks this level, then we can see upward movement in Mahindra and Mahindra. So from 2.5 to 4.5 was a good recovery, but you missed the chance to recover. But options need a lot of practice, lot of paper trading. But as far as paper trading is concerned, I don't see anyone doing paper trading in cash market as well. So are you guys practicing or not? Because I asked you to download IIFL app, and those who are new to the market to start doing virtual trading, because you need to build this habit of trading. Just doing technical analysis won't help. You need to get into the habit of trading. You are doing paper trading, Imtiaz. So you are maintaining a logbook or Excel sheet. What you are doing? Logbook. So what you can do now, see, logbook is good. You maintain a logbook, but what I am suggesting is download IIFL app, log in as a guest. You don't need to open an account. On the left hand side of your screen, you will get three horizontal lines, small lines. Click on that. The menu section will open up. In that, they have a virtual trading platform. So start building the habit of trading now. Whatever technical analysis you are doing, suppose if you filter out any stock along with your targets and stop loss, start trading in that. Start doing virtual trading in that, because you are not using your actual money. So this will, develop your confidence. Even if on a virtual platform you'll see some profits on your screen, then this will build up your confidence. Yes, Chetan has done 2 years pay virtual trading in MoneyBuy and IIFL. Volume weighted average price. See, volume weighted average price is basically, if we look into any stock, what is the average trading price of that stock? Let's look. Now let's take example of TCS only. See, this is the volume weighted average price of TCS. Now, if the stock is trading above 2022, and this is considered to be bullish. Even with the charting platform that you are using, if you look into the indicators, you will get a VWAP indicator as well. Now people generally use it for trading for intraday purpose also. Now VWAP is not, you will not be able to see VWAP right now because the market is closed. Though I have put this VWAP over here, but it is not visible right now. So during the live market, you can see the VWAP. What is the volume weighted average price? If you apply this indicator, and if the stock is trading above that, people use different kind of strategies. They put the pivot points and they apply the VWAP, and then they trade when the price cross the VWAP. Then they enter into the stock. They take a long position in the stock and they hold the stock till it closes below the VWAP. There are many techniques that are used. Or along with VWAP, you can use some other moving average also, say 10 moving average or 20 moving average. If stock is below the VWAP, this is considered to be bearish. Most of the people take entry into the stock when the price is trading above the VWAP. And this is generally used for your intraday techniques. Anything else you guys want to ask me? You can use that Imtiaz. See, the reason why I'm not using MACD, why I'm using RSI is because I find RSI to be more faster than MACD. In MACD, if you add MACD, that also doesn't matter because you can use MACD also in your setup. But MACD is a bit slower than RSI. In RSI, you get signals fast. Because if you will combine RSI with MACD, so sometimes what happens that your RSI is giving you buy signal, but that by that time the crossover has not taken place because this is based on moving averages, and moving averages are a bit lagging. You can combine RSI also if you want. You can use stochastic as well. Stochastic like RSI is also very fast indicator. So you can use MACD with RSI. There is no problem. Even I used to use MACD with RSI previously when I started. I used to use MACD along with RSI, but now I rely more on RSI. Now that's your personal choice. What kind of indicators you want to use? You want to use RSI along with MACD? You want to use RSI with stochastic? You only want to use RSI? Well, these are the common indicators that are mostly used in trading purpose, and we told you about these indicators. Fibonacci retracement. Okay, let's take chart of Nifty. Let's look at the weekly chart. Now from here till here we saw a correction in the market. Now when the market started to retrace back, now if we want to see where the market will find the resistance, or if we want to enter in the market, what could be our possible targets. So what we can do is we can take the Fibonacci retracement level, connect the high. What happened? with the low. We'll connect the highest point with the lowest point. So these are various ratios like 0.786, 0.618, 0.50, 0.382, 0.236. Now 61.8 is considered to be a golden Fibonacci number, and 38.2 is also an important number. So this gives you your support or resistance levels. Like if you see Nifty right here, right now is taking resistance from 50% ratio again and again. It went up till 38.2, and from there again we saw a retracement. And if you see the support is somewhere around 61.8 level. Now you can use this on any chart. If you want to see the levels of any stock also, you can use it. Say let's take example of what. Let me remove this. Now say from here till here we saw a fall in the market. Now if I want to see my possible targets, because Fibonacci retracement is used for your support and resistance and for your targets as well. I'll connect it with the low point. So right now this is at 2.36 level. This could be your possible target. Next. In fact, if you want any further targets, if I add up these numbers, let's check on any other stock. Now see from here till here we saw a fall in the market. So I'll connect the highest point with the lowest point. Now these are my resistance areas and support areas. See how many times the stock is taking either a support or a resistance from 61.8 ratio. Then next it is taking a support at 38.2 ratio. Now these numbers that I added up, if this level is broken, then this can be the next target, then this can be the next target. Now we can also draw the retracement levels from low to high by connecting the low to high. After an uptrend, if we see a downfall in the market, that time also we can connect the low to the high. So if I connect from here, if I see, So see how on 61.8 the stock is taking a resistance from 38.2. Here it is taking a here it is taking a resistance from 38.2. Now if this level is broken, then this could be your possible target. After that, if this target is broken, then this another blue line, this will be your next target. So this way you can use Fibonacci retracement for your support and resistance and for finding out the targets. Got it? Now support and resistance, we have seen Fibonacci retracement, we have seen moving averages, we have seen pivot points, we have seen trend lines, price action. Now tomorrow we will see option chain. From option chain also you can determine where the stock will take a support and what could be the possible resistance for the support for the stock. That also you can find out for your FNO stocks from the option chain as well. See how much point difference should be there. Please check Sun TV. Okay. Yes, see, this is good enough difference. Say suppose if you enter above high of this candle, which is say it's 615.90. Say even if you enter above 620, then the resistance that you are facing is around 698 or 700 level. So you can get if you get an upward movement in the stock. So this is good enough movement. At least around 10% movement you will be getting in the stock. So if you are taking a trade, say if there is a resistance on top of moving average, so there should be good enough gap so you can get a good rally in the stock. In fact, Sun TV is looking good if you enter above 620. So this is the level the stock needs to cross, or wait for it to cross this level. Then it will be around 635. Because see from here the prices, we are seeing a retracement in prices again and again, which is above 630. So if you enter in Sun TV above 630 and your 200 moving average support is around 698, that is good 60 points, which comes to around 10% movement in the stock, which is good enough movement. So Sun TV above 630, 632 is looking good for an entry. Let's look at the weekly chart. See right now anyhow it is on resistance 610. This is 200 moving average resistance on a weekly time frame. As I told you, any resistance on a bigger time frame is very strong support or resistance. So until and unless it crosses this resistance, we can't think of entering into a trade. And you see this level 1, 2, from how many weeks the stock is not able to cross this level. If it crosses this level, then around 680 to 85 can be your first target on weekly time frame. So incentive your entry should be above 630, not before that. Four-hour time frames is okay. 1 hour is okay. Fine. Any other questions or should we conclude for today? Now your option chain analysis is left and your fundamental analysis is left. Stock filtration we have done, but still we'll take 3 or 4 sessions more of your stock filtration. We'll filter out stocks regularly for 3 4 days. And did you guys download Stock Edge app? Please download that because that is very helpful for you in your technical analysis. You can filter out stocks from there. In fact, you can do a lot of research on your stock. Now, when we are filtering out stock, when we are looking at any stock, if the price is increasing, open interest is increasing, volume is increasing. Now, along with this, if you add one more criteria, that is if you see the deliveries. If you see if the delivery of any stock is increasing from past 2 or 3 days, that means people are actually the trading that is happening is delivery based. People are not only trading in the stock for intraday purpose, they are actually taking delivery of the stock. Now, if the price is increasing, open interest volume is increasing, and deliveries are also increasing, so this is a bullish sign for a stock. So you can add this one more criteria in filtering out stocks. So deliveries and all you can check from your, because see if NSE will check delivery, then only you will be able to see delivery of that particular day. But if you check in Stock Edge app, you will be able to see deliveries of past few days. Fine. Any other questions? One more criteria that you can use for filtering out process if you are trading into FNO stocks. Now see in cash, the only thing we can check is volumes. But then when you are trading in FNO, there are various things that you can check, like price increasing, open interest increasing, volume increasing, and your deliveries are increasing. And one more thing that you can see is that there is a good difference between the spot price and the futures price. That is future price. If the stock is bullish, then the future price is more than the underlying value, that is your spot price, and the difference is good enough. Say from 0.50% to 1%, if that is the difference, that means the stock is very bullish. But now what we are seeing here in TCS is that futures price is less than the spot price. That means future is at a discount than the spot price. Similarly, when you're looking for, filtering out stocks for shorting, now if the price is decreasing, volume is increasing, open interest is increasing, and if the future price is less than the spot price, that is, future is trading at a discount, that is a sure sign of bearishness in the stock, and you can go short in that stock. Now, every time you will not find such a situation where the future price is less than the spot price. So you can see how many of your criteria are getting fulfilled. Even if three of the criteria are getting fulfilled, then you can select that stock for your trading purpose. Fine, got it, guys. Any other question? No question, then we'll conclude for today. Fine, then. See you guys tomorrow, same time, 7 o'clock. Bye. Take care.